All right, so this is 3.3. Zoom out a little bit, sorry. 3.3 notes. This is the different transactions we haven't covered yet that will be from your transaction sheet from the previous chapter. We're going to record receiving cash from sales, sold services on account, paid cash for expenses, paid cash on account, and then paid cash owner's withdrawal of equity. These all are transactions affecting the owner's equity and assets account. Sales is an owner's equity account. It's a credit to capital, or credit to sales, excuse me, which increases owner's equity. Owner's equity is a credit account. Sold services on account. When we do sell services, that is sales. So we would credit the sales owner's equity account. When we receive cash, we would debit it. It's the asset. When we sold service on account, we would debit accounts receivable. We pay cash for an expense. Expense is a debit. It's an owner's equity account. And so how do you lower owner's equity? You have to debit it. So when we lower owner's equity, when we deal with an expense, we lower it by debiting the expense, crediting cash. And so as I can walk through these, we can talk through them here in a minute. These are all the transactions affecting owner's equity, recording sales of cash receipts and sales on account. So first one, recording received sales, cash from sales. It's a calculator tape. So what that basically means is that we counted the register. We don't do it every time for whatever reason, but we do this by saying we counted the calculator tape. We added it all up, balanced the drawer, and we come up with $1,100 receiving cash from sales. The tape is going to be the source document, and we will use the date as why it's tape 10. Before we used pre-numbered receipts, sales, slips, invoices, memorandums, checks for our numbers, but for our source document for receiving cash from sales, the calculator tape is the date. That's what they're talking about here. This explains the T account. We increase cash with $1,000. $1,100, we increase sales, which increases owner's equity. Why do we have check marks here? Because when we say previous section, anything written in the general debit or credit needs to have an account type. Well, when we receive cash, debit cash, from sales, increasing sales, both debit and credit are in the special amount columns. So there is nothing in general debit or credit. So thus we put a check mark. We put a check mark here because of posting. When we post to the general ledger chapters from now, we will, in a different chapter, we won't post this one because there's nothing in general debit or credit. The dates is the first step, debit, credit, source document, like always. Second transaction, sold services on account. So we put the 12th. And the services on account to Main Street Services, sales invoice 1. What we're doing here is we're debiting accounts receivable and the company Main Street accounts. And if you Main Street Services, and it'll be in your chart of accounts you can look at. And we're not doing anything with cash. We didn't receive cash. We didn't pay cash. There's not a check here. So cash isn't involved. But sold services on account is an increase to sales, and it says sales invoice 1. So with the sales invoice, we would use the sales slip as the source document. And whatever's written in the general debit or credit is the account title. So we debit the asset account receivable. They owe us money. We will receive that money later, and we credit or increase the owner's equity account sales. Talks about the source document, again, the 4 steps. Pay cash for an expense is a pretty simple one, and we have 2 of them here, 2 different expenses. This time it says we're paying for communication bills, cell phone, internet services, $80 check, and we're paying cash for a rental for rental equipment. Each one of these, I don't know if they have 2 T accounts, I must only have 1, but you would have rent expense, debited, cash, credit, and a T account here if you had another one. But you put the date, you list the expense as the debit. Expense is an owner's equity account. We lower owner's equity with the debit. We increase expenses with the debit, so that lowers owner's equity. Whenever we pay cash and we see check numbers, paid cash check numbers, we know we're going to have credits to cash. So they only have one T account, but it's kind of the same thing. This would say rent expense, $400, $400. So they're just showing you one, but you can understand both. Put the date, the general debit to the expense, the credit to cash, and then the source document check number. Debit, put the date, debit the expense, equipment rental instead of just rental expense. You will find that in the chart of accounts. If it gets tricky, don't worry about it, just look in there. Date, debit to equipment expense for $400. We paid cash, so it's a credit to cash and a source document of C5. This explains that T account. Because expenses decrease owner's equity, increase in expenses are recorded as debits. An expense, therefore, has a normal debit balance. Excuse me. Receive cash on account. On the 16th, we did this from Main Street Services for $200. It's a receipt. When you see a receipt, you know that we received cash often. So accounts receivable, Main Street, is the account that we will be using. We use the date. Now, before, when we sold services on account, we increased the asset. Now we're getting paid. They're paying off their bill to us. So when accounts receivable, when we receive cash on account, we have to lower the account receivable to show that their bill has gone down. Previous transaction showed how the bill went up. They owed us $500 on the 12th, and so now they're paying that bill partially off. When we receive cash, we know we are debiting cash, and we have to lower the account receivable asset. Accounts receivable Main Street Services is a credit. That's how we lower it. We use the source document receipts 1. This explains the T account. This explains the transaction. Last one we know, pay cash to owners, withdrawal of equity. Again, this should be similar to our transaction sheet being one of the last ones. Paid cash to owner, withdrawal of equity. It might say withdrew equity in the form of cash. It'll be a check. When we see that, we automatically know we're lowering the asset cash. It's in the special amount column, cash. Drawing is like expenses. It's an owner's equity account. And how do you lower owner's equity? You must debit it. So drawing has a normal balance of a debit. So you put the date, the 16th. Michael Delgado Drawing is the company. In your chart of accounts, it'll say whatever the person's name is that the business is. Debit the drawing account, credit the cash. We wrote a check, paid cash to the owner, and then we use the source document, check number 6. This explains it further.